Hey guys, today we're going to jump into some finance news from the CNN, and that is a big scary one. 5 signs the world is headed for a recession. Okay, so before we get into this video, I want to comment on something about the news media. And this is going to be a problem if you're always tuned into the news and you're thinking you're learning all of the lessons off the news, because news works on narratives. So what does that mean? A few weeks ago, I commented on another piece of news, which was the US not recession, which I did a video on, which you'll be able to find the link to somewhere in the descriptions or on this screen here. Basically, the US not recession is the fact that the commonly known description or definition of a recession is 2 months in a row of backwards GDP. So your economy shrinking 2 quarters in a row. So that happened in America in the first 6 months of this year. And America came out and said, oh, no, that's not the meaning of it. We're not in a recession, blah, 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 blah. And the thing I want to point out about narratives is that the news media didn't pick up this narrative. And I can guarantee you, if you're watching this, you probably didn't even hear about that. But yes, they've changed the definition of something. That's incredibly scary. Now the narrative's changing because I jumped online last night and all of a sudden it's, oh, the world's headed for a recession, blah, 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 blah. Well, this was on the cards the whole time. So this is why it's important to kind of understand what's actually going on in the world and not just believe whatever's shoved in your face from mass media. The narrative in the past has been inflation. Look at all my videos. It's full of inflation stuff because that's directly involved with interest rates and home loans, which obviously is what I do. The narrative will change from inflation to disinflation or deflation. And I think that's going to happen reasonably soon. How long? No one knows. Timing's really hard. But let me just explain one thing. How inflation is measured is year on year. So pandemic came, the Western world printed 20 to 30% of their money supply to deal with the financial hardships of the pandemic. So what happens is that money's got to flow through the economy, obviously, to do its work. But the offset of that is you see inflation. Now, inflation is measured year on year. What does stuff cost now versus what did stuff cost 1 year ago? Now, this is the thing, like that 20-30% of the money supply is going to work its way through the economy, and eventually it stops revolving around the economy. So what's going to happen is they're going to start looking a year back and go, well, stuff costs more then because there was more money in the economy, but now stuff costs less. That's disinflation. So that inflation is coming back down. Obviously, then media is going to jump on it and it's going to go to disinflation, to deflation incredibly quick. So we just need to understand that tough times are always coming when they printed 20 to 30% of the money supply. We were already in tough times. We were just kidding ourselves in thinking that it would only be a little blip on the radar. All right, so let's start digging into it and let's just take the first couple of sentences. Around the world, markets are flashing warning signs that the global economy is teetering on a cliff edge. The question of a recession is no longer if, but when. So, I disagree with that. I just think they're in recession already. They've been in recession since January this year. When I say they, America, because that's the world trades in American dollars. What I want to say to this is everyone's just been ignoring it. Like the Federal Reserve in America have said they're going to keep putting up rates. They speak at least once a month. They keep on hammering the same message home. And that is that they're going to keep on putting up rates. And I think what we're getting now with all this narrative and all the stock markets almost imploding is that they're starting to believe now that the Fed aren't going to come to the rescue. So in the past 10 years since the GFC, the Fed's always come to the rescue. They'd print some more money, they'd do some QE, which is basically printing more money and putting it into the system in layman's terms. They'd reduce interest rates, and the market's been waiting for that to happen, and it hasn't happened yet. And all of these articles now are basically the market's putting their pressure onto the news media, and the news media is coming out going, oh, this has got to stop. This is a big problem, which it is a big problem, but there's always problems. But it's such a big problem now. Apparently, yesterday, the UN, yes, the UN, don't know what they've got to do with finance, but they've come out and said, America, you've got to stop raising interest rates because this is going to screw over the whole world. What I want to say there is, well, we would be in recession if the Federal Reserve, the central bank, the Reserve Bank of Australia and our thing, didn't keep on pumping up the markets by printing money. So that's point number one. So this is always going to happen. Point number one is, well, they had to stop printing money at some stage. So now they're going into some key trends here. And the first one is the mighty US dollar. So again, they're quick to mention the central banks. Let me just read out this quote. The simplest explanation comes back to the Fed. When the US central bank raises interest rates, as it has been doing since March, it makes the dollar more appealing to investors around the world. So, dumbing that down, the US dollar is the global currency. The globe does 75% of its trade in the US dollar. So firstly, what do we say to that? Well, if the US are raising their rates, it's easier for me if I'm somewhere around the world with a lot of money to own US dollars. And the interest rate is a little bit higher than the rest of the world. So it's more safer to have my money in US dollars. Plus I'm getting a better return on my money. So that is not good for the rest of the world. And as you can see, the last, probably really the last month or so, the US dollar has been going crazy strong, and every currency, including the Australian dollar, is just getting smashed against it. Another example of why the US dollar is getting stronger is most people don't understand like how debt works. Like if I'm Australia and I'm trading with another foreign partner and they don't have the cash, we basically agree, and they don't have the cash. It's basically a loan. So rather than getting them to find Australian dollars and pay us back in Australian dollars plus interest, what we do is we say, well, pay us back in American dollars because 70% of the world's trade is done in American dollars, and you'll easily be able to find that money than finding Australian dollars, for example. So you got to understand that's the way the debt works all around the world. And what happens is, as America keep putting their interest rates up, these countries have to work harder and harder to find American dollars to repay their American dollar debts. So what happens is they generally print money, and then yes, their currency deflates against the US dollar, which is what we're seeing. So the US dollar is a wrecking ball at the moment, and it's a big reason why the economies around the world are getting smashed. So let's go to the next one. America's economic engine stalls. So let's read the first few lines out of this one. The number one driver of the world's largest economy is shopping, and America's shoppers are tired after more than a year of rising prices on just about everything, with wages not keeping up. Consumers have pulled back. The hardship caused by inflation means that consumers are dipping into their savings. Some guy said. So basically what that's saying is people are stopping to spend their money. So what I want to talk about is the bullwhip effect, and you can look this up, you can YouTube it, you can Google it. It's out there on the internet. Basically the bullwhip effect is the cause of that 20-30% print in the money supply. So what happens in the actual real world, let me show you an example, is a heap of money gets printed. People spend it because it's stimulus. That's what it's meant to do. And then what happens is all these businesses start making a lot of money because these people are spending it. Someone else is earning it. So these businesses are earning a lot of money, right? And they think, oh, great times have come. Now I've got to take this money and I've got to reinvest it because I can barely keep up with demand as it is. But what obviously happens is that 20-30% money supply was a one-off print. And what happens is these businesses take on all these staff and they buy all these products even though they're way overvalued. And they say, oh, we're going to get rich next year. That's what we've got now. We've got this record low unemployment and the merry-go-round has stopped. So basically, that's what we've got now. We've got this record low unemployment because all of this money flowing through the system. But now the tides are turning because that money is going And as you can see on this article here, retail are leaving the market. So we're up on the roller coaster and now we're like, and we're about to go back down it. So the next one is corporate America tightens belt. In mid-September, one company whose fortune served as kind of an economic bellwether gave investors a shock. FedEx, which operates in more than 200 companies, unexpectedly revised its outlook, warning that demand was softening and earnings were likely to plunge more than 40%. That pretty much says it all. FedEx are a global company. They're basically shipping goods all around the world. So it's kind of a proxy to say that, well, if FedEx is dropping by 40%, well, the world economy is dropping as well. Added to that, what I want to say is a lot of those corporates are actually victims of the bullwhip effect, and to take full advantage of what they thought was a booming market, they've borrowed a lot of money. Now, this is a big problem because now they're not making money. So earnings are starting to decrease. So on top of that, their interest rate expense, their debt burden, their debt repayments have about doubled for corporate bond yields. So not looking good for corporates. And if you actually look around, there are businesses starting to put people off. Those events were bad enough on their own,